Hey everyone, John Henry here, slingshotfutures.com. Boy, oh boy, what a day today. We've got the market across the board was halted down earlier this morning and last night. So today is going to really be going over something that, fortunately / unfortunately, depending on what side of the fence you're on, we don't get to talk about very often. And that's when big markets halt, like the S&P or the Dow or the NASDAQ or the Russell, or all four at the same time. So one of the big things first is when we're looking at this movement to the downside, when a market is halting, it operates very similar to penny stocks when they're halting. If you've ever traded a penny stock, you know exactly what I'm talking about when they halt, because it does it pretty frequently. But if you haven't, which I'm kind of assuming most of the futures traders out there really haven't traded that kind of environment, and the futures markets halt so infrequently, a lot of people don't know what to do when the markets are moving this much. Now, we have bounced back quite a bit off of the lows, but if we look at the S&P, it's still down 6.5%. So there are a couple things to pay attention to when we're looking at market halts. First of all, it's the halting levels. In the pre-market or post-market, like last night, Sunday night, the largest amount of movement that will be allowed before circuit breakers start hitting is 5%. That's what this giant flat line is right here. That was the 5% barrier. Now, after the market opens up, it expands out to 7%. And then from 7% goes to 13%, and then from 13 goes to 20%, and then if it hits 20%, it's halted for the rest of the day, no more trading. And if it goes beyond that in the aftermarket, there are no more halts. It just keeps on going. So when we're looking at this type of market, first off, we're coming back from a Sunday. We're in not necessarily the first week of a new month, but we're in a new month. And more importantly, we're going into kind of the first quarter of 2020, or at least the end of the first quarter of 2020, and we're opening with a big gap down. The market's fallen 20% off of the highs, which, side note, totally normal. But we see this kind of movement down, and now we're down halting. So there are a few things that we need to pay attention to. There are a lot of levels of interest that are created when you're looking at a down halted move. First off, the obvious one is going to be the big dash line that forms right there on the halt level itself. But there are going to be a lot of other levels that a lot of people don't look at. One of the big levels is the initial gapping candle. Now, this is on a 15-minute chart. But sometimes if you zoom into like a 5-minute chart or even a 1-minute chart, you'll find that a lot of that first, the big chunk of that candle happened in the first couple minutes, just like we have here, right? This is a 5-minute chart, and still the majority of that candle was done in the first 5 minutes. So what I'm looking at is that first candle that's gapping down, because that's going to create a massive zone of interest, not just on the bottom, but also on the top. Now, obviously, we're a little far away from that right now, but the zones of interest, 29.16, and the low of that candle, which is going to be right down there at 28.33. Those are the first two major levels that we want to keep our eyes on. Now, the other levels would be utilizing the same thing, but as a deviation move. So what I mean by that is measuring up the bottom to top of that candle and then going out a full one deviation, meaning that you take that move and you deviate it lower, right? And that gives us support at 27.50. So now you can kind of see where these levels begin building because they create some huge zones of interest. Now we have the high and the low of that candle, 28.33 and 29.16, but we also have the deviation down at 27.50. Now, along with everything else, on some markets, they have massive psychological levels. Luckily for the S&P, that's up at 3,000. But it is going to be another consideration. And then one final consideration is going to be that halted point and the bounces that happen off of those halt points. And if we look, we can see it's very obvious where the halt took place. But we also want to pay attention to not just the halt, but the peaks that were put in on those highs. Those all create a barrier that the market is going to have to work to if it's going to succeed in turning bullish. Now, right out of the gates, we saw something that we saw 5 years ago when the market halted down. When it came to the S&P, we halted in the pre-market. Now, there are some differences. The last time the market halted down, it halted down 20, 30 minutes before the market opened. It wasn't halted for very long. This time around, we were halted all night. There was an occasional bounce here or there when they tried to pop off of the halt level, but ultimately, it just stayed halted. So a little bit different in that regard, but one of the big things that stands out here is when the market did open, it immediately halted down again, right? So not only was it halted when we opened at 9:30, it opened up, expanded out to 7%, and then immediately hit 7%. And then it was halted again. Now, when you hit that first level at 7%, it halts for 15 minutes. Once the 15 minutes started over, it looked like we were going to get a second halt to the downside. We opened up way down here at 27.45 and it flushed all the way to the low 27.14s before starting to bounce back up. And when it bounced back up, it bounced viciously. And this is another thing that happens on these halts when they stop halting down. This is where you go back to some of the penny stock things that you may or may not be familiar with, where the market will halt down and then shortly later it'll halt up as well. The market goes all over the place. Now the indexes don't halt up, they only halt down, but it's kind of the same mentality. The moves up can be just as vicious as the moves down. Looking at the overall charts, the chart structure that we have going on in the 15-minute chart, this is exactly what we've been talking about for several days now. When we compare this drop to the previous drops that we've had, we had a strong move to the downside and a 2 to 3 day rally. The market went sideways after the 2 to 3 days and then began its second leg down on that descent. It's a very common market structure, and that's exactly what we saw on this last move down. We had the giant collapse lower. We went up very strong for a couple days, then went sideways and started teetering off the highs and ended up collapsing down to today, brand new week, and we're halting down. Now, is this the end of the world and everything's falling apart? No. You're going to see that on the news. It's going to be everywhere. The markets are halted. They're halted. The world's falling apart. The market's collapsing. This is where you need to take a step back and think about things as a trader. It's really easy to get caught up in the hustle and bustle, like, oh, holy crap, the world's falling apart. Realistically, though, if you look in the long run, every time there's been a market crash, the rebound after the crash can be anywhere from 200 to 1,000% ROI from the bottom. So when we're looking at this type of movement, if we zoom out to a larger time frame, right? So let's take a look at trading view so we can go out really, really far. And we'll get a look at some of the bigger moves that are going on here. But this is a weekly chart on the S&P. And again, if we go backward and we look at all of the market crashes that have happened, right? Here was a very strong market crash going into 2007 all the way until 2002, and it rebounded back up to a double top. Then it crashed really aggressively, and this is what I would consider a crash, when it happens really fast all at once like that. And from that point, it's gone up easily 200%, going on 300% to the upside. If we go back even further, which I don't know if this is going to let me, might have to go out to the SPX. There we go. If we go out to the SPX, the last time there was an aggressive crash, right? If we go back into the 87, 88s, that was down when the S&P or the SPX was trading at 350. And then it rallied all the way up to almost 1,600. Inside of that, we had another really strong move to the downside. That was, it dipped back underneath 1,000 and then rallied all the way back up to 1,600. If we go from the bigger perspective, now we start seeing these bigger moves, right? This bigger drop to the downside. If we compare this to what we've seen in other parts of the move, at least when we're comparing it to things here, we can look at the price range and we can see, and this is back in 2000, when it fell off the highs in 2000, it dipped 50.39%, give or take, right? Give or take. It's not a perfect measurement. Then it went all the way back up to the highs in 2007, then 2008 housing bubble crash, then it dipped all the way down 57.84%. And then we started rallying up massively aggressive. Now, obviously today, we are a little bit further down, currently down about 19%. But if we're looking at this overall move, look at the typical pullbacks that we've been seeing while this market is ripping to the upside. 15%, 20%, 19%. They're all right around that same area. So this is the zone where if the buyers are going to start taking back over again, they're likely going to be doing it sooner than later. Does that mean that the bottom is in? Absolutely not. This could just be the beginning of a gargantuan downtrend, and maybe the economy does completely fall apart. Don't know, right? We won't know until it happens. But the one thing that we can definitely be sure of is that this is a normal equidistant type as far as percentages go, pull back off of the highs where the buyers begin starting to pick it back up again. It's 20% off the highs. It's a pretty good price, right? It's a pretty good value play. That said, though, looking at the bigger picture, this market move from the upside on the weekly perspective has been non-stop bullish, extraordinarily bullish. And a lot of times when the market finally cracks away from this, it doesn't immediately reverse. You expect this to go more sideways. And it wouldn't be a surprise at all for the next 2 to 3 years where we don't do anything. We just go sideways. I mean, there might be a little bit more dipping inside of here, but in the grand scheme of things, we don't really do much. But, right, a few other things to consider. If this does end up being a 3-push top, and we are falling off the highs very aggressively, the common area for a 3-push top is usually the halfback from the larger move. That halfback is a pretty big deal. So if we draw up that move from the bottom all the way over here, oops, that's not the one I wanted. Let's try that again. Fibonacci tool, where are you? There you are. We'll go down from the bottom all the way to the top, and then let's get our percentages in. That's not right. All right, so the ones that we care about, 50%, we'll do the 618 just for fun. That's going to be the area that we're looking at. Now, notice something interesting about that 50% level. Yeah, there should be something that stands out pretty obviously. 2,000, right? Gargantuan psychological level sitting at 2,000, right on top of the 50, and right back where that first level of congestion where they made the decision to break out more to the upside really kind of kicked off. I mean, yeah, you could argue it was down here, but realistically, this was the first pause that the market had after it started breaking to new highs. We would be right back in that area again, 2,000 to 1,800. And although I'm not saying we're going to be there tomorrow, that is something that we might potentially have to deal with. And as traders, even if it is low probability, we still have to try to be prepared for this type of movement. If we start dipping down into that far, that's where we start really creeping out to our larger portfolios, the dividend portfolios, the IRA portfolios, and looking at, hey, what stocks are really, really good buys that just happen to be getting beaten up by this coronavirus stuff that's going on right now, and the oil market that's crashing right now, right? What markets are in that situation? Take a flashback to 2008 when the markets were crashing. When else would you be able to buy a company like Ford for $1 a share, right? That's the kind of mentality that we have to go into when we're pushing into these giant market pullbacks. It feels extreme, right? It feels like a monster pullback. The market, holy crap, it's falling, it's down 1,000 points last night. But realistically, from a percentage aspect, this is totally normal. The only reason it seems so big is because we've gone so far up. We went down from the lows of 650 back below, before 2010 to all the way up to 3,400. You expect these moves to be a lot more extreme in size, but percentage basis wise, it's the same thing over and over and over again. So the anticipated move that we have going forward, potentially and likely, more downside continuation for a little bit longer, maybe the next month or two, maybe for the rest of the year in 2020. But in the grand scheme of things, we're probably going to start ranging, going a little bit more sideways. If the market does break out of this 20% pullback zone, then we're looking for a much deeper pullback, 50 to 55%, maybe even a little bit lower, back to that 2,000 massive zone of interest. Definitely something that we want to be keeping our eyes on. So lots of things of interest, lots of stuff going on here in the markets, and just a few things to really kind of keep your eyes on if you're not familiar with trading these types of market crashes, because let's be real here, they don't happen that often. This is the first time that it's happened in over 5 years, and realistically even longer than that, where we've had some halting to the downside and some crazy movement. And the last time, that was back in 2008 when we're seeing 58% pullbacks. We're not quite there yet, but this could just be the beginning of that slide to the downside. So be prepared for this to get potentially worse before it starts getting better. Don't lose sight of the long run, though. Every time there's a market dip, there's usually a 100 or more % move back to the upside that doubles up that dip. And, well, there you go. You're off to another massively bullish market over the next decade. So don't lose sight of the long term, but at the same time, in the short term, this might just be the beginning of waiting for that larger pullback. Got to be prepared for all sides. Play it safe. Trade reduced risk, right? Lower the position size. You don't want to get stuck on the wrong side of things, especially when the indexes are halting. That's a horrible time to be stuck on the wrong side of things. Just play it safe out there. If you're going to do anything, do me a favor and be safe while you're trading. That's going to do it for this one. Hopefully you found it useful, interesting, entertaining. I hope you were entertained today. Good Lord, markets being halt down from the weekend. Man, bunches of stuff going on. Anyway, that's going to do it for this one. As always, if you have any questions, shoot me an email, jbrink@slingshotfutures.com. If you had a great day of trading, I hope you have a great week of trading ahead of us, and we'll see you all in the next one. Thanks.